It's the all-new GenWealth Radio Hour, starting with our What's Happening segment. We welcome you in. At GenWealth Financial Advisors, we are here to help people discover, protect, and share true financial independence. I'm Scott Inman, along with me, GenWealth co-founder John Shrewsbury. And as you take that, John, and think about why we're here, and you look at all these headlines that are out there, and we're going to dive in with a couple of them here in this What's Happening segment, it's really crying out for a need to have some perspective, because things out there, the headlines, and we talk, you know this, it's all bad news, right? Usually, the headlines that are out there can really create a fear in people that could be a true inhibitor for them to reach true financial independence.
You are absolutely right, Scott. I've always said that we are really in trouble when we give everybody a platform and a microphone. Mm-hmm. And that's what we've done with, this proliferation of social media and instant communication. It is a real problem sometimes when people who may pretend like they know what's going on, get on the air, so to speak, and talk about things that really either is angled toward their favor, meaning that they're going to get something out of it if you believe a certain way, yep, or that they just run their mouth and don't know what they're talking about.
Yeah, trying to get clicks and likes, right? That's what it's all about, and that can really put you in a bad position when it comes to the truth. Now, we will say the couple of topics we're going to talk about in the What's Happening segment do come from reputable media sources, and the facts are right. I think it just cries out for a little bit more perspective. So the first article we're going to reference is one from CNBC, came out recently. I think it was about a week and a half ago or so. And there you see the headline if you're watching on our video version. Third quarter earnings are indicating a divided economy. Now, here's the good news. According to Morgan Stanley, the median earnings growth among Russell 3000 companies in Q3 is running at about 11%, and that's up huge from 6% in Q2 and 2% in Q1. So we have a earnings growth scenario that is in double digits right now. So let that sink in, because we hear a lot of worry, John, about, the market's been going up for 3 straight years, can't keep going up, we're high, we're too high. But as we talk about, the market may trade a little haywire one way or the other for a short amount of time, but it's always going to settle in due to fundamentals. And this indicates that fundamentals are strong.
Well, clearly, this is the stock market rally that nobody likes. It's just like everybody is waiting on the other shoe to drop.
Yeah.
But here's the truth. If you look under the hood, 83% of the companies that have reported earnings up to this point in the earnings season have reported exceeding their earnings expectations. 83%. I'm not real sure what's wrong with this picture other than the attitude that some people have about this rally. And the fact is that rallies are not time-bound. They can go on for an extended period of time. This is a relatively short rally, comparatively speaking, in history. So I'm just not in the camp of, the sky is falling and, we have people walk in our office and going, what do you think's about to happen? It's all going to go to hell, isn't it? And I just have to go, no, I don't think so. Anyone who has long-term bet against the American economy has lost consistently. And yes, there will be times of turmoil. Yes, there will be times of volatility. Yes, there will be times that you think the sky is falling. April of this year was one of those. When the tariffs hit, everybody thought that was the end of the world. But it wasn't. And again, we are in that situation here. It's just a different subject.
Yeah, let's temper it a little bit with the PE numbers, okay? So the S&P 500 is trading at about 23 times forward earnings. And that is, we won't get into really the particulars of what all that means, but we're going to compare it. It is elevated to the 10-year average of about 18.6. So you can argue that maybe it's getting out over its skis a little bit, but I want to kind of bring in the AI trade to this, because I think that's where the fear comes in, because you hear all of these comparisons to the AI trade or is just like the dot-com bubble of the late 1990s, and that's just not true. So let's point out the differences here. So when it comes to the AI trade, what is happening is there are huge inflows going into already very established, highly profitable technology companies that are using massive capital reserves, cash reserves on the sidelines to fund the research and implementation of artificial intelligence, which i.e. means they're going to get bigger, right? If all that pans out, or of course, they're going to get bigger and more profitable. And if you compare that, John, to the dot-com bubble, which you lived through as a financial advisor, you know that anything that had a dot-com behind it was getting huge inflows, and they had been around for a month.
Yeah, and hadn't made any money.
Right.
And that is the huge difference. If you take a look at the big tech companies, all of them are very profitable. All of them are very large companies. They've been around for a long time. They've got huge amounts of capital on their books, and they're reinvesting into artificial intelligence. I will tell you that artificial intelligence isn't going anywhere except straight up. That's not a stock recommendation trade. That is just what I see in terms of an economic momentum play, that AI is proliferating every business that's out there. At GenWealth, we use artificial intelligence. We use it in a very productive way, but we use it, and we use it to leverage our people to be more productive. We use it to leverage better outcomes for our clients. And so those are things, Scott, that are happening not just at GenWealth, but all over the country in various ways. I was actually on the phone with someone the other day. This was amazing. They had trained their AI agent to have conversations with them. And they said, watch this. And he started asking questions, and this thing was responding with answers that were absolutely spot on. And it was a whole conversation back and forth between the two of them. And I'm over here just stupefied because I have no idea how to do any of that. But he had done it, and he was like, this thing is just amazing.
Yeah, it's exciting. It's also a little scary when you say that.
A little bit scary.
but it's coming, right? It's happening, and it's going to happen.
But let me say this. Yeah. It was a little bit scary when, the farmer who had used, his implements all of his life out in his field, when he saw that first combine roll onto the property. He's like, oh my God, what is that? What's going to happen? I can't afford one of those things. What am I? This is just evolutionary change of society that you're seeing take place. But to your point, Scott, it is a completely different situation than the dot-com bubble that burst in 2000, and we were just, it was a disaster what happened there. Are there some, maybe exceeding expectations on some of these stocks? Probably so, but it's nothing like that because there's actually earnings behind it.
So let's finish this topic up with a few takeaways for investors. So obviously the market has been on a huge double-digit, if not 20% plus tear for the last 3 years. I do think it's prudent to think that growth is slowing, and we won't continue to get that kind of upswing. That is certainly possible. And then the other thing we should be ready for is a pullback or even a correction. This is the thing that people, when they are already on edge, John, about thinking the market is overbought, when that first correction hits, oh man, they're out. They knew they were right, and that this proves they were right. When the reality is, we have to keep the understanding that a 10% correction happens on average about once a year on the S&P 500 or in more broadly the stock market. So you have to expect the volatility. You have to expect things to go in the short term a little haywire.
You know what today's gold star is? Everybody, when you were a kid, wanted to get the gold star in class or whatever the case may be. The gold star today is, see, I told you so. It was going to happen. I told you so. And, right. The fact is a broken watch is right twice a day. And that is a broken mentality that you think, just any time it's going to happen. That's true. At some point in time, it is going to happen, but just not today.
Yeah, and we do believe in the power of diversification, especially as you get closer to retirement. So you don't want to be all in on the market, of course. Have a very good investment strategy that is built for those pullbacks and even more of the long-term bear market, so that you know that you're going to have your retirement income steady and consistent throughout your retirement. All right, let's go on to the next one. The next headline we've got: how soaring national debt impacts mortgage rates and the housing market. So the headline here, we all know the U.S. debt is massive, and it's not just a Washington problem, how the fallout affects mortgage rates. So drawing the line there, did a fastest four the other day on the national debt, and I couldn't believe it, but it's really gone $5 trillion higher just in the last few years. We'd done one previously. I went actually back and looked at the previous fastest four script, and it was like 33 or 34 trillion just a year or two ago when I did a story on it. And now we've topped 38 trillion, highest it's ever been. Of course, that's relative to everything's higher because of inflation too. But the debt has to be financed, and that's through the U.S. government issuing treasuries. And mortgage rates, we know, are heavily influenced not really by the Fed funds rate. I think people think that when, hey, the Feds are going to cut rates, so mortgage rates are going to come down. That's not exactly the direct connection. The more direct connection with mortgage rates is being tied to the 10-year Treasury yield. So when the government has to pay investors more to borrow, then you're seeing that yield go up on the 10-year Treasury, and it's been pretty steady. I don't think it's been soaring, but it's been over 4% for a while, and that's been unusual based on prior economic conditions. And so the concept here is that we're probably not seeing those Treasury yields because of the U.S. debt go down significantly anytime soon. So by extension, we should not expect mortgage rates to go down anytime soon significantly.
So I have to be critical of the current administration in this, because I read that the president is taking a look at a 50-year mortgage.
Yeah.
Scott,
yeah,
that is so just 100% opposed to our mission at GenWealth, which is financial independence. You won't live to get financial independence if you have a 50-year mortgage. It doesn't work that way. A 50-year mortgage will have you paying mostly interest for probably 25 or 30 years. You'll never pay that house off. Now, some people say, well, people don't keep houses, so it doesn't matter. Well, then what you're doing is you're renting the house that you live in from the government, or from the bank, because 90% plus of your mortgage payment is going to the bank. In the early years of that mortgage, and even in the mid years of that mortgage, the ratio of interest to debt elimination payment is just ridiculous. And so to go from a 30-year mortgage, which we would really not like people to do, to a 50-year mortgage is even worse advice.
Did you know that the average price in the U.S. for a home right now is $415,000? If you took that price, put 10% down, and then took out a 50-year mortgage on the 90% that you owed, it would take you 30 years to acquire $100,000 in home equity. 30 years to have $100,000 in home equity. And when you think about, people move around, but that support's not doing it for me, because you're going to have nothing for the next house.
So that would beg the question to me, why not just rent?
Yeah.
Because you don't have the liability. You don't have to buy the homeowner's insurance for the actual property. You do need liability insurance in that situation. You don't have the maintenance. You don't have the upkeep. You don't have anything. So why not just rent? Yeah. Maybe that's what the push is, because a lot of big companies are getting into buying up tracts of houses and then leasing them out to people, which is essentially a long-term rental agreement.
Yeah, and if you want to know more about that 50-year mortgage proposal that's being floated out there, that is actually the topic of our fastest 4 minutes in finance this week. If you don't get that, if you're listening on the GenWealth Radio Hour, you're going to get it at the end of the radio hour. But if you'd like to have it delivered directly to your email inbox, it's a short video. As the name implies, the fastest 4 means 4 minutes or less of content on a video right to your email inbox. Just text the word FAST right now to 501-381-5228. Or if you'd like to go online and visit fastest4.com, you can sign up there. It's fastest spelled out and then the number 4.com. And again, we're not going to blow your email inbox up with a lot of emails. We're just going to send that to you once a week. It comes on Friday, and it's topical. It's about Social Security, retirement, investments, the market. And this week, it is about that 50-year mortgage. And part of my research in that, in building that script out this week, John, it revealed to me that the average age of a homeowner, of a first-time homeowner in this country, has now hit 40 years old. And that floored me, because if you look just 5 years ago, the age was 33 years old for a first-time home buyer. Now, so the first thought in my head was, okay, rates were lower in 2020 than they are in 2025, but they haven't always been lower. So I went back to 1981, and guess what the average age of the first-time home buyer was in 1981?
It was younger.
29 years old.
Yeah.
And what were rates?
They were
huge.
Like 15%.
16%. So it's not the mortgage rate. I think it might be the perception of the mortgage rate, because the people who might be a first-time buyer now remember the 3%, and they're waiting for them to go lower. But that's the point of this topic, John, is that they're not going to go lower significantly. Waiting is probably not the answer if you're ready to buy.
That's right. And I think that if you are already in a low interest rate mortgage, you're probably going to keep it.
Yeah.
If you're smart, you're going to keep it. I know there is the lure of a different house, a new house, or whatever the case may be. But if you've got a 2 or 3% mortgage, that is a true asset from a financial standpoint.
Yeah. So I think it comes back to having a down payment that can set your mortgage payment, a 30-year at the most mortgage payment, at the right amount that you can afford. And I think that's, I was talking to the younger guys in the office today who've recently become homeowners, and they were talking about how you have to be prepared to settle for what you can afford. You can't go out there and get the house that you grew up in just because it's nicer.
Yeah.
You have to get what you can afford, and you have to stay away from other debt. They brought that up, and I thought that was huge too. Staying away from other debt like credit card debt and paying too much for a car and paying for it for 84 months. That's going to be the next thing, 50-year mortgages and 10-year car notes.
Yeah, in some cases, mom and dad worked 20, 25, 30 years to get to where they were when you were growing up in that really nice house that they have. And the expectation is that, oh, well, when I get married, I need to start at that level because that's what I'm accustomed to. But that's just not how the world works.
Yeah. So hopefully that was a good takeaway for you. Don't get into the 50-year mortgage if it does become a reality. We've thrown the math out on that, and we do it even more specifically in the fastest 4 if you want to be a part of that. That's going to do it for the What's Happening segment. I kind of get the feeling John and I could just roll on through the whole hour with this, but we have your questions to get to. The Get Ready for the Future show starts right now.
You've been sold the idea that financial independence is all about some number on your account statement, or even worse, that you don't qualify because of where you started out. That's just not true. It's not about some well-kept secret of the wealthy. It's about finding the right information and knowing how to apply it. On the Get Ready for the Future show, we're answering your questions so you can start making real financial change today. The journey to true financial independence begins right here, and it starts with you.
Coming to you from the 6th floor of 3 Financial Center in West Little Rock, Arkansas, where we help people discover, protect, and share true financial independence. This is the Get Ready for the Future show. My name is Scott Inman, along with me, GenWealth Financial Advisors co-founder John Shrewsbury, getting ready to take your questions on the show. And if you'd like to get your questions into us, there is a quick and easy way to do that. You can send us a text or call this number and leave a voicemail, 501-381-5228. Again, 501-381-5228. Anything that's on your mind, financially speaking, whether it's Social Security, investing, the market, retirement, whatever is on your mind, we'd like to get to that on the show. And think about this too. If you send in your question, you're actually helping others, because I sat with a prospective client this week who's been a longtime listener of the show, and he said he loves listening to the questions that people send in because almost every week there's something asked that's on his mind or that applies to him. So you can help others by getting your question answered as well. Ready to dive in?
Let's do it.
James from Bauxite is up first. I'm 66 and recently realized my IRA still lists my ex-spouse as the beneficiary.
Uh-oh.
Yeah, if I update it now, does that override my will, or do I need to change both? One name on one form can override your entire estate plan. So don't let an old beneficiary designation cause a future disaster. So the first thing we need to be clear on, it does. I mean, that's a beneficiary on an IRA is going to take precedent over what your will says. So the first thing, James, you need to do is probably get online or call your advisor or whatever you need to do to make sure you get the paperwork done and change that beneficiary if that's what you're wanting to do, which the question implies, because a beneficiary designation, this is one of the misconceptions I think out there, is that if I have a will, everything's going to follow the instructions of that will. But with an account that has a beneficiary on it, if the ex-spouse is the primary beneficiary, guess what? If you die tomorrow, James, she is getting the money.
That's right, because a will is certainly it's a legal document, but it is just a statement of your intentions. But the beneficiary designation on an IRA account or any other type of account that has a beneficiary is actually part and parcel of a contract. And that contract contract law overrides the will. No question about it. No ifs, ands, or buts. That's just the way it works. Now, Scott, we had this situation, and I jotted all this down because I had to go back in the archives and actually figure this out.
Been a minute?
Yeah, it has been a minute. But we had a prospective client come in one time with his wife, and among other things, they brought his 401k statement. Well, this was a really interesting situation because the man was on his second marriage, and his first wife was named Mary. Not actually named Mary. The names have been changed to protect the innocent or the guilty in this situation. But the first wife was named Mary. Coincidentally, the second wife was also named Mary.
Uh-oh.
The only difference between the wives' names were the middle initial. And since they had told us that the wife who was present in the meeting room was Mary A., we assumed that Mary D on the 401k statement was a misprint. Well, obviously not. We brought it to the husband's attention, and he had forgotten to change the beneficiary when he married Mary A. Had he died, his ex-wife would have been entitled to the entire $800,000 balance of the 401k plan. That is probably why Mary A. didn't shoot him right there in our meeting room, because she would have given the ex-wife that money until the beneficiary got changed. I'm not sure what happened to him after he got home.
There was a lot of Marys in there. He married a Mary and then married another Mary.
That was a tongue-tied deal. But
an extreme example, but a very good one to highlight the situation.
But that is a sort of a parable of a real situation that happened in a meeting room at GenWealth once upon a time. Now, what happens is that there's all these pitfalls out there. Outdated beneficiary form is a pitfall that you've got to navigate around. It is not a catch-all to just go to your attorney and go, hey, I want to update my will. I don't want to fool with all the other paperwork. No, if you make a change to a beneficiary in your mind, it has to go on paper with the account that you're doing business with.
Let me say this too. That even includes the trust, right?
That's right.
A beneficiary in the trust is a beneficiary of whatever assets the trust holds. But if your beneficiary of your IRA or 401k is an ex-spouse, it's never going to go to the trust. It's going to go directly to the ex-spouse. So beneficiary reviews on retirement accounts, on life insurance policies, anything that has a beneficiary attached to it needs to be reviewed regularly. It's something we do with our clients at every annual review. I think one of the most common ones for me is a daughter gets married.
Yes.
Last name changes.
Yes.
Uh-oh. Well, that's not her name anymore. We need to get that changed.
Yeah, that one is a little bit easier to overcome because obviously it is a daughter, and you can produce a marriage certificate to prove that she once was, whoever, and now she has a different last name. But when you have a completely different person designated as a beneficiary, that's who it's going to. Yeah. And that makes for a really, really tough situation.
Highlights the importance of working with an advisor that's looking out for you on those things. And also any life change that happens to you, it's time to review those beneficiary designations. Hey, you want more free info about retirement, investments, and your money? I want to invite you to subscribe to our YouTube channel, where you can find it there. Just go on to YouTube and search for GenWealth Financial Advisors. Our next question is from Amy via email. I'm 58, and about 40% of my portfolio is in company stock, from where I've worked for 25 years. Should I diversify even if it's been performing well? Amy, lots of things have been performing well, and that's great. What made you wealthy, though, could also wipe you out. If you're overloaded on company stock, diversification isn't optional, it is protection. And this happens. We see it most often when there is a stock grant or stock options component to someone's employment. And that's great, and it does help you build wealth. And sometimes you have to wait. There's a vesting schedule oftentimes, so you do have to leave it there. And then just like the beneficiary designation, maybe you forget about it. And that's a massive number that Amy has built up, perhaps because of the performance of the stock. But she has 40% of her portfolio, and I would say just across the board, that is too much stock concentration.
Yeah, it is a high concentration of risk. At GenWealth, we regularly recommend that people have no more than about 10% of their assets in a company stock. Here's why. You are dependent upon that company for your income. And if your future income, meaning your retirement account, is laden with a bunch of company stock and something happens with that company, then there goes your current income and your future income if there's some big disaster. And you go, well, I know my company. They're probably, I know a lot of people that thought that way about things like Enron and WorldCom and all the other companies that have bit the dust over the years. So you have to be diversified. You have to protect yourself. It is, to some people, it's kind of a loyalty thing. It's like, I'm going to buy the company stock because I'm loyal to the company. Well, are you more loyal to the company than you are your own financial independence? That's the question you've got to ask yourself. And I know that's tough. That puts you in kind of a bind. Scott, I remember back in the old days, it used to be common practice until the SEC stepped in and kept them from it for companies to force people to buy company stock in their 401k.
Yep.
Big bouts of company stock in their 401k. Yeah. They went, okay, that's a conflict of interest. We're not going to let you do that. They still have it available. But to your point, I think that you've got to think about that there is a lot of risk riding on that. And you've got a lot of historical volatility in just single stocks anyway, as compared to a broad market.
Yeah, and I think I would even go one step farther, not only the 10% rule of concentration, but I also see here, Amy, that you're 58 years old. That means you're in the retirement red zone more than likely. You're walking into retirement within the next decade for sure, and maybe less. I would not want to include my allocation to my company stock as part of my retirement income plan. At least not while it's still in the stock, right? Because what I do see is we will build a retirement income plan for our clients that does not include that. And if they don't need it, then they can keep a component of it. It's an extra piece of money that they can tap into if they need to, or if they can pass on to their children, because there'd be a good tax advantage for doing that. But as far as in the portfolio that is going to provide you retirement income, I wouldn't want it in there, quite frankly.
Yeah, I think that there's a couple things here that, Amy made the comment that it's performed really well. Well, as Scott said, it had a lot of things that perform really well, but what you have to understand is that past performance is not necessarily indicative of future results, and that is very true when you are in an individual stock. Markets change, and even strong companies can stumble and falter and that type of thing. I think if it's done really well, you could lock in some gains and go, okay, that has done what I needed it to do, and it's okay to walk away from that. It's a lot easier to walk away from company stock that's done well as opposed to company stock that did well and now it's not doing so well, and now you're going to take it on the chin from the standpoint of you used to have a lot of money in that company stock and now it's something less.
Yeah, let's talk about one other piece to this, because we've walked through this with clients as well. The other piece, when you, Amy, get into the retirement red zone and start talking about supplying yourself with income from your investments, taxes are huge, right? We talk about it all the time on this show. We talk about it in our client meeting rooms all the time. There could be an opportunity to do what's called a net unrealized appreciation on this stock that you have in your employer plan. So what is that? Well, essentially, you'd be able to transfer the stock in kind to a non-qualified account. So basically, you're pulling it out of your employer plan and putting it into a non-retirement account, but you didn't sell the stock. So the custodian of the 401k should have a record of your cost basis in the stock, and that might be part of the analyzation here. But when you sell it in the brokerage account, if you've moved it, you pay ordinary income tax on the basis since it was never taxed, but you pay potentially lower capital gains tax on the difference between the total value and the cost basis. So you got an example that I think we can walk through, John.
Yeah, let's just say that there was a $50,000 cost basis in the stock, and the total stock is valued at $200,000. In that net unrealized appreciation strategy, you would pay normal income tax, whatever your income tax rate is at the time that you transact this. You would pay normal income tax on the $50,000, assuming that it was pre-tax money that went in. You pay normal income tax on the $50,000, and that you would pay capital gain tax on the $150,000. And Scott, that could be the difference in, let's say, 24%, 22%, maybe as high as 37% ordinary income tax rate, and maybe a 15 or 20% capital gain tax, depending on your overall income, most likely 15% on the capital gain of that stock. That is a move that only applies to company stock. So it's something that you really ought to take a look at if you're in that situation.
Yeah, we had a prospective client in the meeting room not that long ago who was very focused on tax planning because he was going to have massive amounts of qualified money. And we were talking about Roth conversions, and we set up a piece of the plan to do that too. But we saw this opportunity. He had a large allocation to company stock as well, and we talked about the net unrealized appreciation option there because he could get that out of the way, right? And that would be some money that would not be subject to RMDs because that was his problem. He was going to have a big pile of money by the time he reached RMD age and have less control over the taxation at that point.
Yeah, you've got options to invest that money after you've paid tax on it that are really not even fettered by what can go in an IRA. So that those are things that deep planning on something like this is really very, very appropriate.
Hey, if that's a new term to you, net unrealized appreciation, and you've got some company stock in your employer-sponsored plan, you'd like to know a little bit more about that, or you'd like to step into the ready-to-retire process and get a retirement income plan built for you, reach out and call us, 866-653-PLAN. That's 866-653-7526, or send an email to info@getreadyforthefuture.com, and in that email or that call, just tell whoever you're talking to you'd like to set up your first appointment with the GenWealth Financial Advisor. It does not cost you anything to have that first appointment. It is just a conversation between you and the advisor to talk about your goals, how we might structure a plan to meet those goals, and then we'll determine if we're a good fit for you, and you'll determine if you're a good fit as well. This is our question of the week. Amy's going to get a free Get Ready for the Future Show tumbler for being question of the week. If you'll email us, Amy, we will get that tumbler out to you. Got a couple of more questions left on the show today. Let's get to Bob from Little Rock. We're 60 and planning to move to another state after retirement. How do we compare the tax implications of different states before we move? Now, before you pack the moving boxes, make sure you're not walking into a tax trap. A smart move starts with the math. So obviously the apples to apples comparison here, you're going to have the same federal taxation on your income, but the state income tax could be quite different depending on where you move to. It could be higher. It could not exist at all. I think that's the appeal of a lot of states, like Florida, I think, is one of them, and Texas, I think, is another one that people move to after they retire because they can eliminate that state tax. But I think if you just stop there, you could be opening up more taxes than you realize.
Yeah, you just have to kind of take it all in. States like Texas and Florida, if you go there and visit, you realize where they get their money. They get it from the sales tax.
Yes.
The sales tax is really high over there. Now, Arkansas has been progressively over the years lowering their state income tax threshold. I think it's just below 5% now in Arkansas. So it's not terribly onerous, like I think California is something like 15%. It's just outrageous. But you have to look at the whole picture, Scott. And I think that sometimes people spend a lot of time focusing on the income tax when they don't look at things like property taxes, sales taxes, excise taxes on certain activities. It's just a real gambit trying to do this. But if you're trying to do it, then there's some considerations some factors that you want to take a look at across the states. First of all, take a look at what the state income tax is on retirement income. Social Security, many states don't tax it at all. Florida, Texas, Nevada don't tax it at all. 401k, IRA, pension withdrawals, some states exempt part or all of that from their state income tax. There is no state income tax in places like Alaska, Florida, Nevada, South Dakota, Tennessee, Texas, Washington, and Wyoming. So, those are areas that you could go and hide, so to speak, from the actual income tax. But I think you got to look at what your spending is going to be to really get the total picture of how much government is unseating you from your money.
Yeah, the other thing I would ask, Bob, are you going to be a homeowner when you move, or are you going to rent? Because that could be a big difference too. If you're going to own a home, the property taxes are something you need to really investigate. And certainly rates vary widely. States like Hawaii and Alabama have low property taxes, but states like New Jersey and Illinois are among the highest. But the other thing, too, you got to remember on the property taxes is you can't just look at the percentage that the state charges, because the home values are part of that. Because I actually was doing some research on this not that long ago for a Fastest Four Piece and found that California doesn't really have among the highest, surprised me. California does not have one of the highest property tax rates, but their home values are astronomical, so they're still getting the money.
Yeah, most of the homes in Arkansas could be transmitted over to California, and they'd be worth multiple millions of dollars.
Yeah.
And so that's where they can get by with a lower rate, but you have to look at what would I be actually paying for a house out there, and then calculate what that is. Scott, one other thing is that there are a few states that still have a estate or an inheritance tax. Now, you can find this in Massachusetts and Maryland as an example. Most states have eliminated them, but you want to think about that because it's worth checking about how you're going to treat your family when you leave assets to them.
Yeah, you know, if Bob is from Little Rock, I'm betting he's not moving to California, though.
Yeah, probably not.
Everybody's moving out of California, right?
Yeah, Texas is getting the benefit of that. Texas and Florida.
Absolutely. But, hey, some great question, Bob, and I think it's a broader topic than just the taxes. I'm sure that you've probably looked into that in determining where you wanted to live, but things like health care, social structure, all of those things. Are you going to be okay with not seeing your family, or maybe you're moving to where your family lives? I don't know. But if you're moving away from family, I mean, a lot of things to consider there for anybody that falls in love with the romantic piece of I'm going to go live on the beach in Florida or near a beach in Florida. There's a lot to consider there, not just financial. So appreciate the question. We do now offer, want to drop this into the program too, that we offer estate planning services. You mentioned the estate tax that exists in some states, brought to mind the estate planning. If you haven't built a will, trust, power of attorney, a healthcare agent, healthcare directive, take advantage of our in-house estate planning specialist here at GenWealth. You can reach out today to book your consultation. If it's a pretty straightforward plan, if it's very complicated, you're still going to want to probably go to an estate planning attorney. But we've got a great service here for people who just need to get it done, right?
Yes.
It's pretty straightforward, but they haven't acted. They don't have a will, or maybe they have a will, but they don't have a trust. It's a great opportunity to get that estate planning taken care of. You can reach out today. The same number I gave earlier, 866-653-PLAN or 866-653-7526, or an email, info@getreadyforthefuture.com. Last question on the show today is from Jordan from Houston. We're both 65 and in good health, but we did not buy long-term care insurance. Can we self-fund care if needed, and how much should we set aside? If you're not buying insurance, you are the insurance. Here's how to prepare for long-term care costs without a policy. First time, we throw these numbers out all the time, but we updated them. According to GenWorth's 2024 data, that's GenWorth, not GenWealth, by the way, a home health aid would run you about $61,000 a year. An assisted living facility is about $60,000 a year. And then when you step into the private nursing home cost, a private room is on average nationwide, $108,000 a year. So this is, I call it, John, the elephant in the room when it comes to retirement planning. It's what people don't often want to talk about, but we have to plan for it.
Yeah, I will say that, first of all, these numbers are a little bit lower in Arkansas, but not a great deal lower. So when you start taking a look at self-funding, as Scott said, you are now the insurance if you don't have long-term care insurance. So if you take, let's just hit the midpoint here, home health care at $61,000 a year. Well, what is the average long-term care event going to be for a man or a woman? It's somewhere between 2 and 4 years. That is the average. But all you have to do is walk into a nursing home and take a look, and you will see a lot of women in nursing homes. Women have longer stays in nursing homes on average than men do. So this whole thing of self-funding long-term care, if you don't have long-term care insurance and you can't afford it or don't qualify for it, you may have to self-fund. And as I've told people before, the nursing home is simply a company that has a bill that they're going to present to you. Yeah. And if you can pay the bill, great. And if you can't, then you have to spend down your assets. And then the only way that you get the state to pay the bill for you is to spend your assets down to approximately $2,000. And once you are a pauper, then the state will step in and say, okay, we'll take care of things. Put this person in a Medicaid bed. Now, what is a Medicaid bed? A Medicaid bed is, frankly, a lower level of care and quality of environment than a self-pay bed. The self-pay beds are nicer. You got more attention and all of that type of thing. It really is not an existence that you want to put a loved one through.
Yeah, and I think we have people come in sometimes focused on trying to get their assets out of their name. Maybe they work through thinking about an irrevocable trust and getting the assets in there so the nursing home doesn't get their money. But I think what you point out is so appropriate to that. It is a bill that is being given to you for services provided, just like any other bill that you get a service from. So it makes sense, rather than to try to get down to Medicaid level and deal with what the service level is, the quality of service or lack thereof is going to be, makes perfect sense to plan for it. And if insurance is not on the table, some ideas here. We talked about those costs. Moderate case scenario you'd need about $150,000 to $250,000 per person. But if you want to go to the higher end cost, you'd need about $300,000 to $500,000 per person. So how do you get there? Well, you need to make a retirement income plan, Jordan, for you and your spouse, using the assets that you do have for the lifestyle you want. You have your income sources like Social Security and perhaps other income sources, layering on top of that a monthly income. And our software can illustrate that and show it to you based on our investment strategy, what kind of income you could expect from your assets. If you don't need all of your assets to provide that income, that's the piece you can peel off and put into a long-term care self-insurance bucket. And then when you see about that end goal of what you're going to need, when you might need care, that's a little bit of a moving target because we don't know when you're going to need care, but we can use average data there. If you're 65, it's probably going to be over 10 years before you need that care. We could do some math to figure out if we put X amount on the sidelines and let it grow at an assumed moderate rate of return, then you're going to be able to have the bucket of money there when you're 75, 76 years old.
There are some things that you could do creatively to try to work on this, especially if you are still insurable. You can put money into a type of long-term care policy, a hybrid life insurance policy. And you're really leveraging the value of that insurance policy against whatever premium you have to pay for that insurance. So if you think about, okay, I'm going to come out of pocket with $150,000 for care for a loved one, there's a lot of insurance that you can pay for it with $150,000 and probably leverage more money than that to be able to have care available for that person.
Yeah, and we don't know where Jordan's assets are currently invested, but oftentimes we will see some people who at one time or another bought a whole life insurance policy that has built up some cash value.
Right.
And you don't need that life insurance anymore, maybe at 65 years old. It would be a great opportunity to leverage what you have built up in cash value to put as a down payment, if you will, or maybe even the full cost of a long-term care policy. And you can do that through what's called a 1035 exchange.
Scott, the one thing that I will also add in this is that you don't think about long-term care until you need it. Yep. And when you need it, it's too late.
Yep.
So it is best to have that conversation with your advisor in your 50s as opposed to in your 60s, because health issues come up in your 60s. And you're likely to not have as many health issues in your 50s as a general rule. So that is something that I think is very important for people to do, is not shoot your advisor when they begin to talk about this, because it is something that is really in your best interest that you need to take advantage of.
Some great questions today about overconcentration in company stock, about changing beneficiaries, and does that trump a will or a trust? Moving to another state in retirement, and then this last one about long-term care insurance. Boy, it just is always a reminder as we go into our final thoughts, John, about how complex retirement can be.
Yeah, you're going exactly where I wanted to go with that, Scott. This is a complex world. It's not getting less complicated. It's getting more complicated. And that's why you need experts to come alongside you. I will tell you that I know my limitations around my house. If I'm trying to fix something around my house, I stop after I, maybe get the screwdriver out or something. And if it isn't fixed by the time I've spent about 5 or 10 minutes on it, then I call somebody. And that's what you got to do as far as this money thing is concerned, because it is so complex. There's so many rules, so many angles on things, and your situation is not necessarily cookie cutter. It is unique to you. So what I think you need to do is get somebody to come alongside you and work as your trusted partner in your journey toward financial independence, and you'll have a much higher probability of getting there.
You got to have a guy, right?
That's right.
If you have a plumbing problem, I got a guy.
That's right.
If you got a finance problem, or hey, navigating through retirement, you got to have a guy or a girl.
Or a girl. I was going to say, I'll take a girl any day that,
Yes.
that knows how to fix a leaky pipe. That's
right.
for sure.
That's right. So if you want to get started on your plan through the GenWealth Ready to Retire process, want to encourage you one final time today to reach out to us one of a couple of ways. You can pick up the phone and dial 866-653-PLAN. That's 866-653-7526. Or send an email to info@getreadyforthefuture.com. And that is all the time we have for this week's Get Ready for the Future show. Wherever you get the show, online, on video, on radio, we are glad that you joined us, and we hope you'll join us again next time. Send us a question, too, 501-381-5228, a voicemail or a text. See you next time.
The GenWealth financial team is available to you 24/7 at info@getreadyforthefuture.com, or call our offices at 866-653-PLAN. That's 866-653-7526. You should personally consult a financial advisor before making any investment, and no strategy can assure success. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Independent Advisor Alliance. Independent Advisor Alliance and GenWealth Financial Advisors are separate entities from LPL Financial.